HSBC drew 67 mentions in a single week. For a UK-listed bank, that is an elevated signal. The stories all pointed to the same place, a potential workforce reduction of up to 20,000 roles, framed as an AI-driven transformation. That framing matters, because calling 20,000 job cuts an AI strategy is a choice. It positions a cost reduction exercise as a growth story, and the question worth sitting with is whether the underlying economics support that framing, or whether the framing is doing the heavy lifting. Start with what HSBC actually announced. The bank is reviewing its organizational structure with an eye towards simplifying processes and reallocating resources across business lines and regions. The scale is significant, 20,000 roles over a medium-term horizon. Alongside that, the bank formalized AI leadership by appointing a Chief AI Officer, David Rice, and expanding the Chief Technology Officer's remit. That structural move is not cosmetic. When a bank this size creates a C-suite AI role and links it directly to headcount planning, it signals that the transformation has board-level commitment, not just a technology team project. The consensus read on this is straightforward. HSBC is late to AI efficiency gains, catching up to JPMorgan and Citi, and the job cuts are the mechanism that converts technology spend into a better cost-to-income ratio. On that reading, this is a value unlock story. Trim the workforce, automate the back office, harvest the savings. That read is not wrong, but it is incomplete. Here is where it gets more complicated. The same week HSBC announced this restructuring, it raised its 2-year fixed mortgage rate from 4.57% to 5.17%. That is a 60 basis point move in a single week. The 5-year deal moved from 4.68% to 5.18%. These are not small adjustments, and they did not happen in isolation. The Bank of England held rates at 3.75%, not because the economy is healthy, but because the US-Israel conflict with Iran has created a geopolitical inflation shock that has frozen the rate-cutting cycle. Before that conflict, markets were pricing in rates falling to 3.5%. That path is now closed. The Bank of England's own financial stability report used the word deteriorated to describe the UK economic outlook. So HSBC is executing a multi-year internal transformation in a macro environment that just got materially harder. Mortgage product availability across the UK fell from 8,500 to 7,000 products. About 5.2 million UK mortgage holders face higher repayments by late 2028. That number was 3.9 million before the conflict began. A bank running a cost program while its revenue environment tightens is not the same as a bank running a cost program from a position of strength. That distinction tends to get lost when the AI framing dominates the headline. Now here is the point most people following HSBC are not pricing in. The job cut announcement and the AI transformation are being treated as one story. They are actually two separate bets with different risk profiles. The cost savings from workforce reduction are relatively predictable. You cut roles, you reduce salary expense, the math is visible on a spreadsheet. But the AI upside, the part where HSBC's productivity and service quality actually improve because of automation, that is not a spreadsheet item, that is an execution bet. And large-scale AI deployment in a regulated financial institution across retail banking, wealth management, trade finance, and compliance functions is genuinely hard to do without compressing service quality or triggering regulatory scrutiny.
HSBC's own analysts flagged that model risk and governance oversight become material concerns when AI moves from pilot to production at this scale. That is not a warning about the future. It is a description of the present. There is also a personnel dimension that tends to disappear in restructuring narratives. Cutting 20,000 rules while simultaneously asking remaining staff to adopt new AI-powered workflows creates dual pressure. The people executing the transformation are also the people most uncertain about their own positions. That dynamic affects execution quality in ways that don't show up in cost-to-income projections until they already have. Two scenarios from here. In the first, the restructuring delivers. AI tools reduce back-office friction, the chief AI officer builds governance that satisfies regulators, the headcount reduction flows through to sustainable margin improvement, and HSBC's Asia-focused book generates enough revenue momentum that the UK macro headwinds are a manageable drag rather than a structural problem. On this path, the current valuation looks like a discount to intrinsic value. The $200 million syndicated loan completed for GLEX infrastructure in Vietnam is a small data point, but it is consistent with the Asia origination engine still running. HSBC's analyst team is actively publishing sector calls, Sun Pharma, Bharti Airtel, and TPC, which signals the research and advisory business is not in retreat mode. In the second, execution slips. The AI rollout takes longer than planned, restructuring charges exceed expectations, and the UK mortgage book faces credit quality pressure as 5.2 million households absorb higher payments through 2028. On this path, the cost-to-income ratio improvement gets deferred, and the stock re-rates lower as investors question whether the transformation thesis has a credible timeline. The honest assessment is that the evidence does not cleanly resolve between these paths. What it does suggest is that the market is currently treating this as a straightforward cost-cutting story, and the AI framing is lending it a premium it has not yet earned through execution. HSBC's senior unsecured bond issuance, $130 million at 10-year tenor, signals that debt markets remain open and confident in the credit. That is a floor of sorts. The bank is not in distress, but debt market access and equity value creation are different propositions. The restructuring is real. The AI ambition has structural support with dedicated leadership. The macro environment is genuinely more difficult than it was 3 months ago, and the execution risk on a transformation of this scale in this environment is higher than the consensus narrative currently prices. That tension between a credible efficiency program and a harder-than-expected operating backdrop is what 67 mentions in a week actually reflects, not resolution, unfinished business.